Hi guys, this is Teacher Party. I'm doing the ratios. Okay guys, it's ratios, theory, and concepts. So I'm just going to be doing one video per ratio. I'm not going to lump them up because there's lots of them. So I'm going to start with profitability ratios. So what is ratios? It's what we use to interpret and analyze financial statements. Your financial statement is income statement, which is your statement of profit and loss, statement of comprehensive income or profit and loss, or statement of comprehensive income and profit, something like that, but the SOI. And then the statement of financial position, which is a balance sheet, the cash flow statement. I've not seen you being questioned on the statement of changes in equity in grade 12. However, emphasis has been put so much on the notes, which is the ordinary share capital note, the retained income note, and all. Okay. So let's just get right into it. The profitability ratios, they work so much. The common denominator on the profitability ratios is sales. The common denominator is the numerator that changes. I said, guys, accounting is heavily intertwined or integrated with maths. So that's why I'm using denominator and numerator. Okay. So let's start with the first one, gross profit. So gross profit is your net sales minus cost of goods sold divided by your net sales. So if you don't have any adjustment to the debtors allowances, it is your sales minus your cost of sales minus your cost of sales divided by the net sales. So just gonna check something here on the IEB, the formula sheet. There you go. See, here on the IEB, the formula sheet, they just put, let's just cut that piece. They just put the sales. But you know, guys, if there's debtors allowances, you need to adjust that. If there's debtors allowances, you need to adjust that. And it might be the trick they use to catch you. So guys, in the IEB world, you're going to be given the formula sheet. I'd like also, I'm not sure, let me not assume. I'm not sure in the NSC, but you should have the formula sheet. Okay. So what does it mean when you have a high gross profit margin? It means the business maybe received a high discount. So if the business received high discount, okay, before I explain what I'm explaining now, it's not enough for you to calculate the ratio and get it right. You must explain it. There is so much maths in the explanation rather than in the calculation. So you must master the explanation on top of the calculation. Okay, so the first one saying the big purchase discount. So if you purchase inventory as a business and then you get a huge discount, obviously your cost of sales is going to be lower and your sales is going to be higher because you're not going to change the sale price because the sales price because you got favorable supplier prices, supplier discount. So you will make more money because the discount is going to give you more profit. We call this competitive advantage when you can supply the same goods in the market at the same price, but then having to procure them at a very low price. Okay. So finding a less expensive supplier. So switching suppliers, it never made sense when I still practice as an accountant why they would always be negotiating with suppliers. I felt like the relationship should make sense. But if the business relationship is to make sense, suppliers should be offering favorable terms to the buyer. It's called the bargaining power of a buyer. Okay. Marking up goods or selling goods at a higher price. So that will result in a higher ratio. But the company must be careful that they increase the goods into an ethical to an ethical standard. It must not be unethical because then it's ripping off customers. 4, the markup should be competitive, not to chase customers from the company, and it should be ethical business practice. So What are the points that you can write, or what does it mean when the gross profit margin is low? It means there's poor pricing strategy. You're acquiring something at 20 Rand only to sell it at 21 Rand. I mean, really. You're actually not even covering any cost related to acquisition, which is your transport, so it's poor pricing strategy sometimes that result in low gross profit margin. Low sales volume, not selling as much as anticipated. Also, the company not using not producing their products efficiently. So sometimes the machines they use to produce the product might be old, consuming um, the machines might be old, so they consume more electricity. They need more fixing, and they produce less. So sometimes it could be a reflection. Strong competition. For example, once there's an influx in the market, once there's market saturation, you can't charge as much as you want. The competition will push the price down, especially the companies that are supplying information technology gadgets. They usually suffer a lot from this. Suppliers increasing their prices. That's the company not negotiating, waiting for the supplier to increase the prices, because it's the economic cycle, guys. Someone is gonna try and make a profit out of someone. So it's just that's why the companies need strategy to circumvent or counteract any of such. Okay, then stock losses arising from theft, damage of stock, shrinkage, and all that, and obsolescence. So that could cause, because then this results in write-offs. So write-offs, they always reduce your gross profit. And depending on which line they are recorded, if they are recorded at costs of goods sold level, they will reduce your gross profit. If they are recorded at operational expenses level, they will reduce your net profit. So guys, like, subscribe, share. Now we're going to go to the example, 3 examples that talk about this, and then we're going to practice this.